Assembly Finance and National Planning Committee will republish the Central Bank Amendment Bill 2020 to get public opinion on issues that deal with digital credit providers. The move follows the death of Bonchari Member of Parliament John Oro Oyonka, who sponsored the bill, according to the committee's chairperson Gladys Wanga. This comes as a report by PricewaterhouseCoopers shows regulations which are focused on consumers' protection will ensure the growth of a digital lending environment in the country amid calls to curb predatory lending.
While digital lending has witnessed exponential growth in recent times and helped boost financial inclusion, players in the industry have been accused of abetting predatory lending to unsuspecting customers and at the same time lacking stronger consumers' protection safeguards. The CBK Amendment Bill, which was being sponsored by the late Bonchari Member of Parliament Oro Oyonka, sought to give CBK powers to regulate the conduct of digital financial lenders since there was no law to govern the sector.
According to our standing orders, we have to carry out public participation, and we are happy to, engage with all stakeholders on this matter. As we said, as both the Digital Lenders Association and also the regulators and other stakeholders have alluded, there are challenges. There is a silver lining on innovation in fintech, but there's also challenges. The challenges include over-indebtedness by our populace, include the fact that there's no data protection for clients, include the risk for money laundering and so on.
According to a comparative study on the regulation of digital lending by PricewaterhouseCoopers, commissioned by Digital Lenders Association DLAK, digital lending regulatory environment should ensure consumer protection principles are embedded in the recommendation Consumer Credit Code, which include transparency and fairness in dealings with consumers, transparent pricing principles, disclosure of key terms and conditions, and restrictions on certain debt collection practices.
The regulatory framework should protect the consumer from harm. In that same regard, we should ensure that because we are going into more digital economies and a digital world, we don't stifle innovation, right? And that's what's important. So it's finding that right balance between protecting the consumer from harm and ensuring that we can continue innovating as fast as we do right now.
The report further backs the formation of a dispute resolution office to ensure disputes with credit providers are promptly addressed. The office will have the ability to liaise with the regulator to address serious complainants by consumers.
We should find a humane way of getting that money. Then we used to have the credit reference, which was going to help us in terms of borrower behavior, that if your name appears there, most people would not want their name to appear there. And what did the central bank do? They removed that.
The office will have the ability to liaise with the regulator to address serious complaints by consumers. The white paper rules out prescribing a prudential licensing framework, as it would increase the compliance burden for lenders, the cost of credit for consumers, and monitoring burden for the regulator. According to the report, stringent rules on minimum capital requirements, financial adequacy, and reporting local shareholding requirements would impose significant compliance cost on participants and stifle growth of the sector. The report looked at digital lending market in 11 countries.